Good morning, everyone. My name is Jeremy Forrest with Premier Pro Wash and Seal, and today we're going to do something a little different. I've had videos showing how we wash or how we seal and those kind of things, but something that's very important to me is investing. As an individual, I have been buying stocks for over 20 years, and I know right now the market's kind of volatile and a lot of people are either really scared or they're interested in buying stocks. So I thought that I would put together something that hopefully helps you value a stock, whether it's a good buy today or not. I see a lot of people, they get on Facebook or they get on any of these social media platforms and they'll see a stock that once was $100 and now it's $50, and so they just assume that's a good buy, they buy it and they hope the price goes up. That's not investing, that's just hoping. And I've been a victim of that myself, and I've made money that way, and I've also lost money that way. But I want to show you a way to value stocks that whenever I apply this principle, I've always done very well. And just to give you a little synopsis of my performance, if you look at history, they say that only 12% of mutual fund managers or money managers are able to beat the stock market over a 10-year period or more. In essence, that means that 88% of people will not beat the stock market over a 10-year period or more. I've been investing for over 20 years, and I have personally beaten the market over that period by a few percentage points. So I think I have some validity, although I'm not a financial advisor. I do want to admit that. I have no financial training. I do have an MBA degree, but that doesn't mean that I have financial training. I've done a lot of reading. I read every single day something about investing. I'm a huge Warren Buffett fan, so I'm definitely a value investor. And this is something I came across over 20 years ago. And quite honestly, I haven't seen it since. I haven't seen a video on it. I haven't seen a book about it. I cannot even remember where I saw this. It was something to do in regards to Warren Buffett. I do remember that. I found this piece of information over 20 years ago at a Barnes & Noble in Wichita Falls when I was stationed there. And when I saw this for the very first time, a huge light bulb went off, because many of us, again, we see a stock that's 50% of what it was 4 months ago and we think that's a buy. And so we run out, we spend our life savings buying that stock, and we're essentially hoping that it goes back up. I want to open your mind up to a different way of valuing. And again, when I use this principle, it has rarely ever failed me. So let's get started. You'll see that I have a bunch of numbers up here. The 1 through 10 on the top row, that represents the number of years. So year 1, year 2, year 3, and so on. So when I'm looking at a stock, if I have interest in it, there's several things besides this that I look at. Obviously, CEO and management is very important. But when it comes to the metrics, before I dive deeper into other important metrics, this is one of the first things I do to see if that stock or that business is even worth investigating into. So one of the things I look at is I look at the last 10 years of earnings per share growth, that's EPS. And so when you see 10 years ago, year 1, this had an earnings per share of 3. The second year, 3.5, 4.03, and so on. You see it incrementally climbing. And that's positive. That's a trait that Warren Buffett looks for as well. You want to see earnings per share, you want to see it consistently rising. I don't want to see 3 here, $2.5 here, $4 a share here, back to $2 a share. That's too inconsistent for me. I'm not saying you can't make money buying into a stock that way. I'm just sharing with you my preferences. I prefer to see that earnings per share consistently growing over that 10 years and growing at a healthy rate. I don't like sporadic growth. I do understand, like during pandemics and things like that, on year 10, closer to 2020 or 2021, that earnings per share might have shot down, but I can take a year or two where it shoots down. But again, I don't want to see it every other year as sporadic. I like to see it consistently climbing. So if you look at this, it goes from $3 a share 10 years ago to $10.48 a share 10 years later. If you break that down over the last 10 years, the earnings per share growth has been roughly 13.32%. So that's good, especially for a well-established business. That's what I'm after. I'm not after small businesses, speculative stocks. I am now because I've built my dividend. I've built my foundation. So I can be a little bit more riskier than I would be when I first started out. I believe strongly in building a strong dividend foundation of a portfolio versus going out and buying high growth stocks. I did it opposite. I built my dividend portfolio, and now I'm using that money to kind of tinker around with a little bit more riskier stocks. But my foundation 100% is in deep value dividend stocks. So from year 1 to year 10, we had a earnings per share growth of 13.32%. Then I'll break that down a little farther. I want to see if that stays consistent. Over the last 5 years, the earnings per share growth has been 11.39%. And over the last 3 years, that earnings per share growth has been 9.10. So I see that in the last 3, 5, and 10 years, I've got growth, earnings per share growth, somewhere between 9 to 13%. And that's good. Like I said, it's consistently growing. It is, as you can see, slowing down a little bit over the last 5 years. 5 years, it was 11.39. The last 3 years, it's been 9.10. So roughly around 10% earnings per share growth is what I will calculate later on. Down here, this next row of numbers, you can see the PE. And this is what is just really mind-boggling to me. PE stands for price per earnings. And when you see a company that's got a PE of like 100 or 150 or even 80, I see people all day long on social media encouraging their friends and family to go out and dump all their money into these high growth stocks with PEs in the 80s, in the hundreds. I've even seen in the 300-400s. That's not for me. I'm not saying you can't make money that way, but I'm not willing to spend. Basically, when you got a PE of 100, that means you're willing to spend $100 for every $1 that company makes. There are a few Teslas out there in the world that 10 years ago that might have worked, but I like the percentages in my favor. I actually prefer companies with a PE less than 20, but for demonstration purposes, I just want to show you what this means. So over the last 10 years, you can see they've had a PE. This company has had a PEs from as low as 21 to as high as 30. But if I look at the average over the last 10 years, the PE has averaged 21. Broken down a little farther, over the last 5 years, it's averaged 24. And over the last 3 years, it's averaged 21. Right in line with the 10-year average. So that tells me that I can realistically expect that this stock will sell for a PE somewhere around 21. Now, putting this all together, how do I know if the business or the stock I'm looking at today is worth buying? And for me, I'm not a day trader. I've never bought a stock with the intention of selling it within a year. Again, it goes back to my Warren Buffett philosophy. I believe in long-term value. So I always have the mindset that when I personally buy a stock, I'm buying it to never sell. Now, is that realistic? No, I've bought and sold plenty of stocks. But that is my intention. Usually when I sell, it's because that stock has increased in price way beyond when I anticipated it, so I take my profits in. But anyway, how do I know if this stock that I'm interested in today is worth buying? Let's say that the stock price today is $125. Well, if I look and in 2022, It's got an earnings per share of 11.74. I take that $11.74 now, and I project out 10 years with an estimated growth of 10%. So I like to be a little conservative. You can see that the earnings per share is ranged between 9 and 13. So I didn't use 13, I didn't use 9, I used 10. So if we start out right now at earnings per share in today's dollars at 11.74, and over the next 10 years, if I achieve the same growth rate as the history of this stock, somewhere around 10%, I can guess that 10 years from now, I can realistically guess that the earnings per share of that stock will be 30.45. So it'll grow from 11.74 now at 10-year growth of around 10% earnings per share. It's going to be about 30.45. Now, with that 30.45, I look at the last 10 years of the PE, price to earnings. And you see over the last 10 years, the PE has averaged 21. Over the last 5 years, it's been up to 24. And again, at the last 3 years, I like to do this to make sure there's consistency. I don't want to see the last 3 years, it's 35 and 8, and it's too inconsistent. So I like to see that this is pretty consistent between 21 and 24. So in the last 10 years, PE has averaged 21. In the last 3 years, it's also averaged 21. So I can realistically assume that 10 years from now, as long as we continue to grow our earnings per share growth rate at around 10%, then I should expect a earnings per share at that 10 years from now at 30.45. Well, when I multiply that by 20, because again, I like to be a little conservative, that tells me 10 years from now, I multiplied it by 21. That 30.45 times a PE of 21 gets me a future value of that stock at $639. Okay, that sounds pretty good, but is it worth investing in? For me, if you know about the history of the stock market, you know long term it gives you an average of around 11%. So I'm not going to invest in an individual stock if it can't return me at least 11%, because if it can't, then I might as well just invest in the index. So I like a margin of error. So that's why for me, 15% is my minimum. I'm looking for a return over 10 years of at least 15%. That way I get a little bit of margin of error. And that has worked very good for me. So again, going back, 30.45 future earnings per share times an average PE of 21 equals $639 10 years from now. Today, that same stock that I'm interested in, it sells for $125. So I use my little calculator. You can do this online. There's lots of calculators out there, a compound interest calculator that will speed this up for you. But if I take today's price at $125 and 10 years from now, I'm estimating it's going to be somewhere around $639. That tells me that I should expect around almost an 18% return on my money year after year. If that stock pays a dividend, then those dividends are just icing on the cake. Let's say that they pay a 4% dividend and you reinvest that dividend over that time, then you can realistically expect maybe 19 or 20% over the next 10 years into that stock. Again, if you reinvested the dividends, which is something that I strongly advocate. All right, so 17.72% over the next 10 years. It's definitely got my interest. Again, this isn't the only thing I go off of, but it has met one of my main criteria. So now I can dive deeper into that stock and start, looking at the financials and whatnot. But let's pretend that the stock, instead of selling for $125 today, it's actually selling for $265. Well, if I take the price today of $265 and I project that in 10 years from now it's going to be worth $639, what does that average out per year? And I already did the math, but it averages out to 9% a year. So for me, that's a no-go. Again, when the market returns 11%, there's no sense in me investing into a business or even looking into investing into a business that's only going to return 9%. My margin of error, what I'm looking for, minimum of 15%. So there's more to it than this, but I hope that if you take this little bit of information that I've given you, that this will at least give you an idea of how to value a stock. Because that's probably the thing that I see that lacks the most on social media, is people are just out there guessing and they're buying a stock because Morningstar gave them a high rating, or again, they see that it's 50% of what it once was and they rush out and they spend a lot of money buying that stock, but they had no idea how to value it. This isn't a perfect system, but again, it has worked very, very well for me. I wish I knew the book. I have looked and searched for that book over and over the last 20 years. I haven't seen any videos on this, but if it helps you near as much as it helps me, then that's the success. So I hope you enjoyed this video. I will break down some more criteria that I'm looking at when I'm looking at a stock if I have some interest in that. Thank you.